Sanjay Dutt, Director at Quantum Securities, is now joining us. He's the market pastor for the day. Good morning, Sanjay. Good to have you with us. Seems like a long gap since we spoke with you. Okay, well, first up, the IT pack itself. Are you satisfied enough with their performance? Would you add on, give a little more space to IT and to TCS in your portfolio?
I think, in my opinion, we first need to stop defining it as an IT pack anymore, because clearly we're seeing the numbers the last few quarters. We've started to differentiate men from the boys. You know, TCS, HCL Tech, quarter on quarter for many quarters have been outperforming the sector as well as their peers, and in particular the setbacks that Infosys has faced and is going through its management rejig. But so therefore, coming to your question, I think I would say that on the technology sector, one would have to take selective bets. Amongst the large cap, obviously TCS, HCL Tech, these kind of stocks definitely look better. Infosys, I think, will take a little time to go through its transition. It's on the right track, no doubt. I sincerely hope that the new management transition is successful and new management takes over and handles all the issues that have been there in the past 2-3 years. But no doubt, TCS has been a stellar outperformer, both in terms of performance and numbers, and obviously in terms of stock performance also.
Hi Sanjay, good morning. For today at least, the IT stocks have cushioned the fall on the Nifty, so it's not, too bad a reaction. We're only down about 0.2%, but the mid-caps are selling off a fair bit. Would you be worried about the high beta mid-cap, stocks in the infrastructure, real estate, power lot?
No, I wouldn't be worried, Reema, because what you're seeing is a typical bull market action where you see a sector rotation. Because if you look back last 2 to 3 months, technology sector has underperformed or has corrected, whereas banking, infra, and some of the beta names have come up substantially because they were grossly undervalued. They've corrected very aggressively over the last 2 to 3 years, and they're basically doing the catch-up act. And now what you're seeing in these sectors, whether it's capital goods, banking, some of the high beta names, infrastructure, power, etc., they're retracing, consolidating their gains. People are evaluating once again which are the good ones to have, which are the men from the boys, and then once again the good ones will start moving ahead. But of course, the easy money, has been made in most of these sectors and stocks. The gross undervaluations have been corrected, but I wouldn't write them off. I think they are the ones which are going to be the leaders for the next 2 to 3 years.
Oh yes, you were the first to spot it, Sanjay. I must add that you were bullish on the financials, I think way back in September when everything was falling around or falling down. But how are you looking therefore at the index? You think that 7450 itself will prove to be a fairly strong support, or at best you get to 7200? Should one wait for that before one buys those who got left out?
One can't really game the correct level of the index, Lata. It's really difficult to get down whether you will see a 7200 or 7450. I think a focus on individual stocks within the Nifty also would make you more money than just playing the Nifty. And in my opinion, that the Bank Nifty will obviously outperform, continuing as it has in the last few months. So therefore, if you want to play an index bet on every aggressive fall, aggressive correction, Bank Nifty would be the would be the index to trade. But of course, if I were to hazard a guess, and all guesses are wrong, and my hunch tells me that 7400 would hold, because we start seeing support coming in, just like we saw phenomenal sector rotation starting to happen at the 7400, 7450 levels. So some sector or the other, or group of sectors, a group of stocks, start giving support to the market, because there are certain base prices of various stocks which I think would hold in the next foreseeable future, barring of course unforeseen events. So if I were to really take a call on my hunch, I think 7400 would hold, and 7200 or 7100 should not be seen in the near future.
Okay, well, which financials, which are your favorite banks or levels? And actually, I might add, since we're talking about financials, we've got a question from Money Control Borders, who can ask you directly. Manish writes to us from Jaipur, and he wants to know if it's a good idea to bet on Muthoot Finance at the moment. I think the gentleman has read the Reserve Bank's small banks draft rules.
I haven't tracked that stock, but a broader answer to his question would be that it would be better to move to quality names because they'll be bigger beneficiaries of whatever action the regulatory action the RBI is taking and the new policy measures taking for payment banks and all kind of systems to bring about financial inclusion. I would definitely look at better names than Muthoot Finance. Some more established NBFCs would be a better bet than Muthoot in my view. But of course, with the caveat that I haven't studied Muthoot in great detail, so it won't be a absolute qualified no to Muthoot. But my call would be that there are better bets to look at, something like a Sundaram Finance, Reliance Capital, Bajaj Holding. There are a lot of these companies which would benefit from the new regime that's coming in from the RBI.
Okay. And to my question, which are your best bank picks?
I think, Lata, some second-rank PSU stocks look very good to me. I think whether part of the consolidation exercise they benefit or whether it's part of new fundraising, what the finance minister talked about, dilution in terms of to retail investors, or whether it's a sell-off to retail investors, all banks need money to capitalize and actually meet the growth targets or kickstart the growth that economy the finance minister is talking about and the new government is talking about. And I think any bank in the public sector bank with relatively clean book or low NPAs or low restructured assets in the sub kind of $1 billion valuation, $700, $800 million valuation, and having branch networks of 1,200 to 1,700 banks, there are many of them. They are the ones that one should back at this point of time and would give you relatively high returns over the next 2 to 3 years. No doubt, if you want to have a passive approach to the bank sector, then go and buy the leaders. That's the likes of Punjab National Bank and State Bank of India, etc. But if you want to be a little active in your portfolio, expect high returns with a tad higher risk, then I think second-tier PSU banks would be good bets.
Sanjay, you indicated that high beta will, lead the way from here on over the next few years. So far, the rising tide has lifted all boats, but from here on, the performance could get, a little more differentiated. So, can you separate the, men from the boys in infrastructure as well as real estate with stocks and someone bet on at current levels?
Very well put, Riva, because that's the key issue now. Because, like I said, like you also agree with me. Easy money has been made, so therefore you need to get into the right stocks. I would say stocks in the infra space belonging to larger groups who will have the capability to raise money to restructure their balance sheets and take use of the growth cycle in terms of new orders, in terms of issues that they've had with government policies and government logjams in terms of payment clearances, contracts, etc. All infra stocks which are basically managed by larger industrial houses, larger industrial groups, or even in fact second-tier groups who have a good amount of experience in this space for about 5 to 20 years would be the beneficiaries of this restructuring, and they are the ones who would now go out of the beta pack and the ones who would perform. I wouldn't really go by the positions they have or anything, but what really comes to my mind. Companies belonging to, for instance, absolutely beaten honorably good Jayaprakash Group, the GMR Group, the Reliance Group, they would be able to raise capital overseas and within India and restructure their balance sheets and make use of the opportunities that will come in the infrastructure rollout. And similarly, many companies which are working in the other sectors like railways, ports, etc.
Okay, real estate?
Very picky there, very selective, and that too for a little longer term. Beyond 2-3 stocks, I wouldn't want to touch them because there is still a phenomenal problem in terms of inventory, pricing power in the market, geographical, concentration and exposure in terms of inventory and their commitments, cash flow issues. I think real estate still has a difficult time. Barring 1 or 2 stocks, I wouldn't want to keep anything in my portfolio.
Okay, on risk-off days, mid-caps will perhaps take a beating. Generally, what are the mid-caps that come to the mind? We saw some big gains in Crompton, obviously, because of the demerger announcement. But really, the quality mid-cap space, what do you watch?
I think in the capital goods space, of course, like I mentioned, in the banking space, in the financial services space, whether second-tier non-banking finance companies who would benefit from, all the financial inclusion, etc. Companies which do a lot of contracting work for the likes of L&Ts and BHELs and BEMLs and those bigger companies. These are the kind of companies I think one should be looking at. Some of them, or in fact, most of them would be in the sub $500 million market cap category, or probably in the $700 to $1 billion enterprise value, and would have the ability to sort out their balance sheets or don't have much of balance sheet issues and debt issues at this point of time. But these are the ones which I would want to look at.
Okay, Sanjay, we'll leave it at that. Thanks so much for joining in. Always a pleasure to get in your views.
Thank you,
That's the opinion. 7,400 on the Nifty should hold.